This channel is for educational purposes only. Make sure you do your own due diligence before making any investments. And there is inherent risk in trading, so it's speculative. Just make sure you keep that in mind.
Hi, this is Joe. We're going to talk about the S&P today, and I want to discuss. I'm going to take a quick look at how the market is situated right now, but then I want to talk about pullback risk and the difference between pullback risk and trend risk. And this will make a lot more sense as we get into the chart, but it's a very important distinction, and it's especially important based on where we are right now in the market. So let's go ahead and get into this chart. I'm going to, again, I briefly go into the overall market conditions. The sentiment numbers didn't change. It's at 47%, still at elevated risk levels from that standpoint. Also, there wasn't much change at all in the volatility. We got a little bit more volatility over the last few days, but it hasn't made any impact on the average true range line. So, but as we can see on the monthly chart, we've gotten sort of stretched away, continue to get more stretched away from the 18-month line, which is in an uptrend right now. Weekly chart is moving higher. And again, that is starting to get a little bit of stretched away. Not that bad. I mean, not to a point. Like if we pulled back from here, that would probably be pretty healthy. We're still keying on this 18-week line, which is really the most important line, I think, in this trend. Every time we pull back to it, it seems to hold it. And we'll probably do for another test of that line somewhere between 39.50 and 4,000 sometime over the next few weeks would be my bet. So I think that's what is in store here. We are currently on the daily chart in the process of pulling back to the 18-day. The momentum conditions actually look about as good as they've looked on the daily chart. However, if we go and look at the hourly and take a closer look at it, we are actually we've got a trend line break, and now we've gone to test this high up here. And now if we come back down, if we can come back down through this level right here, then we've changed the short-term trend, the hourly trend, to the downside. And that'll probably put a decent amount of pressure on the daily line, the daily 18. And I wouldn't be surprised if we want to come back and test this breakout area, which is right around 4,000. That would make sense to me. And we'll just have to see if the momentum is really strong on that move to the downside. Or if it even happens. I mean, it's very possible we'll hold these lows and turn right back up. But just overall, looks like it wants to maybe come in a little bit. And again, if we change the hourly trend to the downside, I think there's a better chance we maybe work our way down to 39.50 to 4,000. So that's kind of what I'm looking for right now. And so one of the things I wanted to show, and I'm going to pull up the monthly chart. So I want to explain how currently we've got an 18 above the 40, both lines rising. And really, if you could go and look at this, really since the market turned here in 2010 and the 18 started rising, you've had one period where it flattened out right here and another period where it was kind of flat for like a month, not very long. But you haven't had any real situation where the 18-month line really rolled over and price was below it and rallied back underneath it. And that would be kind of like a sell signal if we get the 18-month to roll over. So we just haven't seen that yet. But if you do notice, we've gotten pretty far away from the 18-month, just like we kind of were here. And actually how we were on the downside here, sort of got stretched away up in here. So these are the areas where, up in this range where you get a little bit too far away and it tends to pull it back. So these are the spots that you're looking for. And then this is where it was overdone on the downside. So when you get too far away from that line, as I've said in the past, it kind of pulls you back like a leash. And so the question is, what is it going to take to really top this market out? Because right now we've got a rising line here. So even if we pull back, that is going to be it's going to be a pullback to rising moving averages. That's more of a buy signal than anything. And so if we're going to do a real reversal in trend, I don't think it can do it from a peak like this, going straight up. I think what we probably need to see is a range form here where we go sideways for a stretch of time. And then when you come through the moving averages, you've actually built up some distribution. So we need distribution to take place. And distribution is really increased volatility and not upside price movement. So where you don't make upside progress and yet the volatility increases. So we're looking for kind of, bigger swings that don't make any upside progress. And that would, to me, be a sign of distribution. Now, if we can do that prior to coming down to, say, the 18-month or the 18-week or the 40-week or whatever, then you're going to put a lot of pressure on those lines. And so let's go ahead and look at, let's go back in time, because I want to show you the two real bear market moves. Just keep something in mind. Before I go into that, I want to make sure you understand this drop here. So we made a move from here to here, and then we made a move from here to here. This was considered a bear market because it closed 20% below. On a daily basis, it actually dropped 20%, closed 20% below the high. This one didn't qualify because it didn't close at a 20%. It actually dropped 20%, but on an intraday basis. So this is considered a bear market. That's not. But in my view, I don't really consider them bear markets because this one was 14 weeks long and this was 8 weeks, 7 weeks long. And I don't think that's enough time to build up any kind of a distribution top and really get these moving averages to roll over. That's really, to me, what defines a bear market in my view, because I'm looking for a long-term trend change. That would be where the 18 crosses down below the 40, even if it's for just a month or two. But we have it where it actually crosses to the downside. So again, let's go and look at, historically speaking, there were two times where we've had that. One was back in 2000, and we topped and dropped down to 2003. And then in 2007, we peaked out and we dropped down to 2009. Both of those, to me, qualify as true bear markets because they weren't just quick drops that didn't roll the moving averages over. They were just really quick. These actually, look at the way this played out. So I wanted to point this out. If you notice where this started, this made a move to the upside, pull back, and then here you basically went sideways for about a year. This whole area is about a year in time. And then when you broke the 18-month, the 18-month was already flattening out on the first bar down. It hadn't even made a big drop or anything. So the fact that this one bar caused this to flatten out, and then we got a little bit of follow through, bounced off the 40, and this was just a humongous 40 to 18 bounce right out of my book, the 40 to 18 bounce pattern. And on this rally back up where it failed and started to move down, it was a major sell signal where we actually broke the 18 and rallied back to it where it was rolled over. I'm going to clear this off so you can see this is rolling over, right? And that is failure at the line. Now we make another big run to the upside, and then we spend about 9 months going sideways. But again, when we broke that line, it was already starting to flatten out, and we found support at the 40 again. And this is a classic all the way to the 18, which was rolled over. Another really nice sell signal as that failed there. So these are patterns we talk about for trading, right? We're looking for opportunities to look for this. I mentioned about 100 times in the videos the not only the 40 to 18 bounce, but the break of the trend line, the rally back up, and then the failure at the 18, and that's really the sell signal. And that's essentially what we've got taking place in these trends. This is trend failure. This is a trend reversal in the long-term trend. This is where your long-term investments become heavily at risk. in areas like this, in areas like this. What we're dealing with right now is not to say that there's not some risk here, because this is why I say the farther we get away, the more risk there is to pulling back to the 18 and the 40. So every time you get too far away to the upside, there's a lot of risk of a pullback. And I think that's where we are right now. It's not necessarily where we're looking for a big trend change, though. It's more of a pullback in the trend. So one of the things I also wanted to mention, these quick drops where sentiment gets really bearish. Now, I told you that right now, currently, we have 47% more bulls than bears. At this bottom, we had 14% more bears than bulls. And so what happens when you have a really quick decline like this is you correct the overbought condition. You have an overbought condition. It's totally eradicated in a very short period of time, and you get people bearish. Those are actually buy where you want to be more aggressive on the buying of the pullback and the sell-off. It's where you go through a distribution top that gets disturbing to me. If we start to see increase in volatility and we don't make a lot of upside progress and we keep churning sideways, that's where it's going to get a little bit more dangerous in my view. So anyway, I just wanted to point this out. Make sure you hit that like button for me. Also, if you have any questions on this or comments, please feel free to post them. All right. Talk to you next time.